In today's episode, we'll dive into a detailed analysis of the personal consumption expenditure (PCE) data and its impact on market pricing. Additionally, we'll explore the recent surge in global transportation costs. Finally, I would like to flip through a few charts that might be helpful. Hi everyone, I'm Roy Güllüoğlu. Welcome to another episode of Market Update featuring by Marketsall and Rationale. Before we get started, make sure to subscribe to the channel, and if you find this video helpful, please give it a thumbs up. Also, if you have questions, please leave as a comment to the video. We would be glad to answer. Let's begin with covering economic calendar and review highlights event since our last video. After the lower than expected Michigan consumer sentiment data that we received in the previous week, we received a higher than expected consumer confidence number. Considering the good data, bad pricing narrative, the consumer confidence data supported the risk-off sentiment. Beginning from Tuesday, there were US Treasury auctions, and they were the decision maker of the last week, at the beginning of the week, and the demand for treasuries was not that bad compared to previous ones, but it was away from the market expectations. So combining good CB consumer confidence data and bad US Treasury, bad demand on US Treasury auctions, US 10-year yields jumped back to the above 4.5% levels and led to risk-off pricing across the market at the beginning of the week. I would like to show you the impact on both US 10-year yield chart and the secured overnight financing rate, which is known as SOFR futures contract chart, which is a financial derivative that allows investors to hedge or speculate on the futures level of interest rates. You can consider this as the price of treasury itself. If 3 months yields go up, that means the chart that I'm going to show you goes down. So the probability of rate cuts are also derived from these futures contracts, especially the 30-day version of the one that I'm going to show you. That's why these are pretty crucial to forecast the potential rate cuts or rate hikes. So yeah, here, and yeah. Here, as you can see, this is 3-month SOFR futures contract. If this goes up, yields come down, and vice versa, due to the nature of the bonds. As you can see, why I'm trying to highlight this one, there's after a huge downtrend here, as you can see, here there's a consolidation started to establish, and this might lead to, if you can call it like a rectangle if you omit if you do like this, or if you can do like this. If we see further upside movement from this, that might 1, 2, 3, 4, then I would expect to come a bit lower, then go up. So that's why this is the chart that I'm monitoring for the market perception about the potential rate cuts. Yeah, that's why I found it pretty important. And yeah, in Fed's Beige Book released on Wednesday evening, it was highlighted that economic growth has moderated as consumers cut back on spending due to high prices. Business representative consulted for the report noted that the consumers resisted additional price increases, resulting in smaller profit margins despite rising input costs. The key takeaway from the Beige Book is that while growth remains moderate, main districts observed consumers push back against further price hikes, which impacted profit margins for sure. As in summary, like, it suggests that while the economy continues to grow, it faces headwinds from high prices, affecting consumer spending and business profitability, and the potential risks of distorting the economy is mentioned in general. And the German CPI data on last Wednesday, the ECB meeting next week likely to bring a rate cut. Despite this, German inflation came a bit higher than they expected. It didn't change the main story for sure, but I mean, the last time that I checked the probability of rate hike, it was around like 95% or something for the meeting of this week. And also we received the real real GDP increase data. It increased at annual rate of 1.3% in the first quarter of 2024, and according to the second estimate from Bureau of Economic Analysis, this is a revision from the previous advanced estimate of 1.6% increase. So mainly due to downward adjustment in consumer spending, as I mentioned in the Beige Book. In comparison, that downward revision, we see both reflection on the GDP data as well, this consumer spending issue. Also, in comparison to real GDP grew by 3.4% in the fourth quarter of 2023. So from 3.4 to 1.3. And also we received that there was a Fed member speeches, and one was like a pretty important one. Atlanta Fed President Raphael Bostic has optimism about the normalization of the high price pressure seen during the COVID-19 pandemic, but that this normalization might not occur until 2025. That's what he said. And he said, like, we still have a long way to go to reduce the significant price increases we've seen over the past few years. He also suggested that the fourth quarter of this year could be time to consider preparing for a rate cut, and also mentioned that that significant price case remains and reduced inflation breadth would increase confidence in cutting rates. And last Friday, China's manufacturing PMI for May once again fallen into contractionary territory. It impacted the copper price directly. I had mentioned in my previous video the potential scenario for the copper. Let me remind you again that one. As you can see in this copper chart, especially in the weekly one, I had mentioned this potential formation of cup-fit handle here. And this last week price action, you can see that 3.19% came down, especially after the China PMI data. And as you can see, if this trend continues, I would expect around this level, like 436, 440 levels might act as a support, as this line, this area might work like that, and it might turn back here and go to formation, considering the upcoming rate cuts from the especially developed economies, because as you might expect in developed, if the rates comes down in developed economies, business are expected to expand, and their demand for China products would increase, and the demand for China product increase would mean that there will be a demand for the copper or other commodities. That's the part that I wanted to mention for the copper. And then we received the May CPI data for Europe. It came higher than expected. It didn't change the main scenario of a rate cut in the first meeting, as it happened in German CPI that I mentioned just a little earlier. But it was not good data for the progress of disinflation path, which is in line with the German CPI. But it didn't change the main scenario for the rate cut. I'll come to the details on impact of PCE data on the market as a separate slide. But Chicago PMI signaled problem in economic activity. Then on Sunday, OPEC Plus announced that they will extend supply cuts into the third quarter, but plans to gradually reintroduce barrels to the market over the next 12 months, which will increase the supply and lead to price to decline. Then on Monday, the Kaizen Chinese manufacturing PMI number came in, and index indicated the strongest expansion in nearly 2 years. So this two like OPEC Plus and Kaizen index like combined two data kind of canceled out their impact on the especially crude oil, Brent oil. OPEC Plus news influenced negatively as it means an upcoming increase in the supply. On the other hand, Chinese PMI signalized an increase in the demand for the oil. I would also like to go through the chart of the oil with you. As you can see in the daily chart, there was an HNS bottom formation here. It broke out. This was one of the main idea that you could have found in the Rationale newsletter. You can subscribe through the link below the video, and it broke out from here. Then it pulled back, and old resistance, new support is still trying to hold. But the negative side is the price is trading just below the all like short and long-term moving averages. And when I come to the higher time frame in the weekly chart, as you can see, there's a potential to form a symmetrical triangle chart pattern after a downturn, after a like downtrend. There's a consolidation over here, and this might act as a bearish continuation if it breaks down here, and that would be in line with the idea of potential supply increase in oil. And in the vice versa scenario, we would expect to go here, and I would be monitoring a potential breakout from this around here. The PCE data. This data is closely monitored by the Fed for its inflation targets compared to CPI data. It's like the number came in line with the market expectation per like a Bloomberg forecasts. Personal spending especially showed a weaker monthly. Here you can see weaker monthly numbers, 0.2% compared to February and March. Real personal spending, as you can see, recorded a monthly decline for the first time since January. The headline monthly number has remained 0.3% for the past 3 months, with a yearly change of 2.7, and for the core side 0.2, like the lowest since December, with a yearly change of 2.8. So the PCE side headline and core data support the disinflation path, unlike the first 3 months of the 2024. I would prefer to shift my focus to personal spending and consumer spending. As I mentioned, some alerts for the Beige Book from the details in the real GDP number in the previous slide. And also in PCE numbers. I would like to focus here a bit rather than getting caught up in other details, as there haven't been a major changes in PCE data. So right now the market prefers inflation data that do not match what we saw in the first 3 months of 2024. Both CPI and PCE data suggest that the trend of disinflation is continuing, plus personal spending is starting to look weak. I believe this narrative is the reason that S&P 500 gave a reaction to the bad demand on Treasury auctions and closed 0.8% higher last Friday. Also, President Joe Biden is pressuring leaders on both sides of the Israeli and Palestinian conflict to reach an agreement with a new three-phase ceasefire plan released by White House on Friday. That might have a positive impact on markets as well. I would also like to show you decline trend on Dallas Fed trimmed mean PCE metric. The Dallas Fed trimmed mean PCE inflation rate is an important economic indicator tracked by policymakers and analysts. It's a measure of inflation that aims to capture the underlying trend in prices by excluding extreme price movements. So the April number 2.94%, and as you can see in the chart, it's coming down. By focusing on the middle of the distribution, this method this captures the change in prices for most goods and services, indicating a clear reflection of the prevailing inflation. So by this approach kind of reduces the short-term fluctuations in the inflation rate, which can otherwise occur due to temporarily volatile factors like energy and food prices. Also, it's majorly concerned with labor market slack, making it more reliable alternative for inflation metric. That's why it's also pretty important and considered taking into consideration by policymakers. Another issue that I want to mention quickly, the freight costs that had been the main topic during COVID. Global transportation costs are on the rise once again as it happens. The container freight index has jumped significantly year to date, as you can see in the chart. Here in the blue, like the chart, the blue line is freight index, particularly just from Shanghai to LA. The red line is composite freight index. Apart from that, you can also follow Baltic Dry Index, which is also related to freight costs. And you can also see the jump in the freight transportation services index year to date. This surge is caused by the rush actually to prepare stocks for the 2024 winter shopping season, driven by longer routes due to the Red Sea attacks and increasing insurance costs. I mean, could this lead to a potential supply crisis as it happened in COVID and harm the disinflation process across the all economies is the question. It would be good to keep an eye on this side as well as a potential geopolitical risk. Here in this slide, you see the SPDR sector tracker table, which shows the year-to-date performance of each sector. Here, I would like to highlight technology and utilities sector. The technology sector's strong performance is obvious, actually. It's driven by AI. But what about the utilities? Like, according to Goldman Sachs, this surge is linked to the increasing electricity demand needed to power the AI revolution. They predict 15% annual rise in data center power demand over the next 7 years, with data centers accounting 8% of total US power demand by 2030. Some experts find it similar to the same with the widespread adoption of air conditioning. You can think like that. And for the ones looking for utility sector exposure, here you see holding some equities that are related to in the utilities sector. Just also as a potential trade idea for this narrative, I would like to show you the chart of Invesco solar ETF called TAN. The ticker is TAN. Then I would like to take a look at a few more charts before closing. So here you can see Invesco solar ETF, the ticker is TAN. In the daily chart, after a huge downtrend, there's a consolidation here, and as you can see, like after a consolidation, a breakout occurred, and this breakout also occurred just above the 200-day moving average, which is a trend breaking action. But I don't know, like you can. I mean, here I think risk management is pretty important for this game, for this play, because I would be trading, like if I'm gonna be here, like maybe I can just like I would risk less than my regular one, because maybe this might act as a fake breakout. Then we might see it come back and hold by short-term moving averages here, black and blue line. Then we might expect to see another one in order to see more consolidation, because if a major move is going to come after a tightness, after a longer consolidation, what I observed up until now, it seems more healthy for me. And also I would like to show you a few more charts. Well, this is real yields. Generally, real yields is the first thing that I open my PC, then if I start to look at chart, what's going on in the market, I start with real yields, because real yields is the thing that you get a risk-free yield. And if this risk-free yield is the kind of a driver of the market in general, if you get less yield from risk-free side, you would search for more yields from more risky assets, included in commodities, equities, precious metals, and stuff. That's why after real yields, I check generally if there is an impact of, let's say, decreasing yields on precious metals. In general, I find some relationality between, for sure. And here, as you can see, it's coming down and converging to the lower band of this parallel channel. And I will be more risk averse as it converts here, because if we see a rejection from here, that means that real yields will increase, and we might see to some risky situation and more in risky assets and also precious metals. That's how I'm monitoring the real yields currently in the short term in the daily chart. And when I jump to US dollar index, you see the similar picture. And I had mentioned this symmetrical triangle that I keep monitoring in the weekly chart. As you can see, there's a symmetrical triangle establishing in the weekly chart after a downtrend. But in like a daily chart, I keep monitoring this parallel channel. And if we're gonna see a rejection from here, we might see a breakout from symmetrical triangle as well. Let's jump to S&P futures. Yeah, these lines can stay as well, but yeah. So here, as you can see, after a huge base, there's a handle formation. This might act as a cup with handle formation, but if it doesn't act like that, I mean that will be so natural to see a consolidation around this level to act like this, and if that happens, we will see the long-term moving averages will converge the price as well, and this will act as this might act as a support with this support level. That scenario seems valid as we see some more tensions in geopolitical side, plus this rate cuts inflation issue keeps if it maintains. And also I would like to show Bitcoin in the weekly chart. As you can see, huge base and little handle, another cup with handle. I'm questioning, I mean, that's not like an ideal one for me, but I also following the 69K level. This potential breakout also coincides with this long-term weekly channel's middle part. I mean, middle line of the channel, generally, it's questionable if it's valid or not. But as you can see for this one, it seems valid. Try one, try two, trial two, and try three breakout. Here almost there. You know, it's subjective issue, but yeah, I just wanted to mention as well. And I will also like to show you the Apple chart, as I see a potential rectangle chart pattern formation here. It's nicely consolidating here in the, let me show you the daily chart. Here you can see, you can find many more trade ideas like this if you subscribe for free the Rationale newsletter service. You can find equities, FX, cryptos, and a lot of this kind of trade ideas. And I try to mention some of them as much as possible in these videos. In general, like this week also pretty important. Like the key events are the ISM and non-farm payroll is gonna come in US, the ECB meeting in Europe, and the export data in China will be crucial. We will be watching, and that's all I'm gonna talk about this week. I hope you found the information here valuable. If you enjoyed what you watched, please consider subscribing to our channel. That means a lot. And it will help us to create more content like this. And please don't forget to hit the like button. And thank you for watching, and we'll see you in the next one. Have a good one.